Hey, so how did Donald Trump pay $750 in taxes? In this video, I'm going to show you how Donald Trump paid $750 in taxes and how you can too. Now, specifically what we're going to talk about, I will share with you what tax strategies Donald Trump used in his business and how you can mimic these exact tax strategies. That's right, how you can mimic these tax strategies. We're also going to dive deep into two tax strategies from his tax return. So you guys probably know his tax returns have been revealed and they have been released. So I've reviewed them and I'm going to be sharing with you my findings. And we're going to dive deep into two tax strategies from his tax return that can potentially bring down your taxable income to zero. As a bonus, we're also going to talk about, does Donald Trump use C corporation to pay less in taxes, or does he use pass-through entities? Ready? Let's go. All right, awesome. So before we dive into it, just a quick thing. My name is Boris Musheyev. I'm a CPA and a tax strategist. Should let me make my screen bigger so you guys can see me. I'm a CPA and a tax strategist. Every Tuesday, I release a tax strategy video on YouTube. So please go ahead, make sure you subscribe and hit that notification button. So every time I release a tax strategy, you get notified. We also have a bunch of resources for you in the description below. So make sure they're free. So make sure go ahead and use them. But other than that, let's dive right into it. So in 2016 and 2017, Donald Trump paid $750 in taxes. These are actually copies of his tax return. Okay. Now, what we're going to focus in this video, we're going to focus on 2015 and 2016. So I've reviewed those returns thoroughly, and I've outlined a few things that I wanted to share with you guys. And we're definitely going to dive into that today. Now, before we get into it, right? Do you remember that debate that Donald Trump had with Hillary Clinton, right? She's like, oh, you don't pay any taxes. He's like, that makes me smart, right? It's like, what makes Donald Trump so smart? Why does he brag about the fact that he's smart? If you guys remember that debate, and by the way, we're not getting political, right? We're just getting factual over here. But if you remember that debate, she said, you don't pay any taxes. He says, because I'm smart, right? I don't pay any taxes because of the laws that you and your colleagues in Congress put into the tax code. Now, I'm rephrasing him, of course, but he basically said that's because of the laws that you guys have put together in the tax code. And Donald Trump happens to know these laws. Why? Probably he's got the smartest people working for him, such as tax advisors. By the way, if you have a tax preparer, you do not have a tax advisor. You need to get a tax advisor for yourself. Now, back to Donald Trump. Now, when he looked at the tax code, I'm pretty sure he's like, all right, I'm a guy that likes to go big, right? So what can I do? And he looks at the tax code and he uses the biggest and the best write-offs. Now think about that. What is the biggest write-off you can have in your business? Okay, you put away money into your retirement account, $61,000, right? Or you buy a car, right? And before the year end, your tax preparer says, oh, I don't know what to tell you, buy a car, right? But what if you strategically do it like he did? Now he's like, what's the biggest write-off in the tax code that I'm allowed to have? And that is real estate. And he uses the power of depreciation. It's no secret. And in this video, I'm going to show you how that works, right? And if you take a look at this is what he tweeted, I think, and I've got it from Forbes magazine. It says, I pay tax. Like, who said I don't pay tax? Like, I do pay tax, but I have a write-off. A lot of it is depreciation, which is a wonderful charge. I love depreciation. That is what he says, I love depreciation. There's no secret. I'm not doing anything illegal, so to speak, right? And the biggest and the best write-off that is available in the tax code for everybody, every American, regardless of what size of the business you are, is a depreciation. And that is exactly what he did. Yes, he had business losses from prior years to offset his business income in some years. That is true. Yes, he used tax credits. That is also true, along some other things that he did in his business, on his tax return. All of that is true. But one of the main factors is a depreciation on real estate. That is something that is available to everyone. Not everybody might have business losses or claim business tax credits or research and development tax credits like he did, but he used depreciation, and you can too. Right. And if you really take a look at this other article that I put together for you, Trump is justified in saying that his billion plus of tax losses may not have been financial, meaning to say he was positive on a cash flow. He was profitable with a cash flow. But what the government gives him in a tax code is a depreciation to write off against his income. Just like you as a business owner can have a profitable, a very, very profitable business. But at the same time, the depreciation from your real estate purchases can bring back your profitable income, net income on paper. But in reality, on cash flow, you're very, very positive, right? So his losses may not have been financial. I mean, say, I did not lose money out of pocket, so to speak, right? I was just able to take a write-off that the IRS gives me. Of course, these are not his words. I'm just kind of paraphrasing it. So what is really depreciation? We're going to talk about what is depreciation, what is accelerated depreciation, because regular depreciation doesn't give you a huge deduction, as does the accelerated. And then we're going to talk about how to write off real estate losses and become a real estate professional. But hey, I don't mean real estate professional to go get your real estate license. Just meeting the IRS tax code, the definition, meeting the definition of the IRS tax code. Hey, Boris Musheyev here. Sorry for the quick interruption. 5 seconds, I promise. I want to make sure you get your free PDF, 7 write-offs every S-corporation business owner must know. The link to this free PDF is in the description below. That's it. Thank you so much. Continue watching. Now, what is a depreciation? Now, I'm going to give you a very quick example. Depreciation is basically a useful life. Every asset, according to the IRS tax code, has a useful life. So when you buy an asset, you can't just write it off. You have to depreciate it over the course of the year. The asset could be depreciated over 5 years, 7 years, 10 years, 15 years, and so forth. Real estate, on the other hand, if it's a residential property, purchase price, divide by 27.5 years, and that is your deduction every year, okay? If you take a commercial property, you have to depreciate it over 39 years. It really takes a long time to deduct what you purchased, right? 39 years to deduct what you purchased. So Donald Trump looked at the tax codes like, all right, what is the biggest and the biggest write-off that I could have, right? The biggest expense for my business. And he's like, all right, that could be buying real estate. And can I use accelerated depreciation? And can you as a business owner? You absolutely can. How? So no wonder, by the way, Donald Trump is investing in hotels, real estate, buildings. Why is that? Casinos, where he owns the building. Think about that. Because when you invest in real estate in America, and here's the thing, every accountant out there, I shouldn't say every, I take that back. Most of the accountants, and I used to be one of them. So, all right, that's because I didn't know tax law when I was just a preparer. Now I own a tax advisory firm and I know these laws, right? Most accountants, when a client comes in and says, I bought a real estate property, we say, is it residential? Perfect. We write it off over 27.5 years, depreciation. But the IRS actually says, no, you are wrong. You can't just do that and penalize the taxpayer. Believe it or not, IRS says that. Now I'm paraphrasing what's written in the tax code. IRS says you can actually segregate the property into different components of assets that make up the property, right? Segregate it out. There's some assets in the property that, whether it's cabinets, carpentry, wiring, whatever that is, that has a useful life, 5 years, 7 years, 10 years, 15 years. So it does not have to be deducted over the course of 39 or 27.5 years. IRS says you can deduct it over 5, 7, 10, or 15 years. That is a beautiful thing. Now, fast forward to 2018, Donald Trump becomes president, and then all of a sudden we have this beautiful special depreciation rule that used to be 50%, now 100%. Any asset under 15 years gets depreciated over any asset under 15 years gets depreciated over the course of 1 year in its first year. So when you buy real estate, the biggest and the best write-off that you could have is buying real estate. You can have a successful business and you're making all the profits. People tell me all the time, how do I pay $0 in taxes? How do the rich people do it? Look, rich people use business losses they had before when they were developing this huge business. They use tax credits. They use a couple of other things, but they also use real estate depreciation. Now, real estate depreciation is applicable to everybody, and everybody can take advantage of it. So you've got a profitable business. You can buy real estate to write off your profit. And real estate can allow you to have accelerated depreciation. So you will have loss on paper, but be cash flow positive. Now, that is how you write off real estate against business income, using that accelerated depreciation. Now, not everybody can qualify to write off real estate losses. Why is that? Because before 1984, 1986? I think 1986, when Reagan became president, right? There was a law, exact same law. Buy real estate, accelerate depreciation, and write it off your income. But at that time, there was no such thing as passive losses. That means any W-2 employee, for example, doctors that made $500,000, $700,000, or $1 million on taxes, it's like, man, I make too much money, I pay too much in taxes. Let me buy real estate, let me do accelerated depreciation. They bought that real estate, they did accelerated depreciation. Guess what they did? They wrote it off against their W-2 income. Reagan became president, the tax law changed. They said, no, you can't do that. All right, wait, the government is going to go broke. Okay, the government is going to go broke. Now, what they decided to do is that we're going to put a limitation on that. The only person that is allowed to write off real estate losses from rental properties against their business income are those individuals that qualify as a real estate professional under the IRS tax code. So keep it simple for the purposes of this video. A real estate professional is, you have to meet two criteria. Number one, more than 50% of your personal services in your space, what you do, has to be devoted to real estate, and it has to be at least 750 hours. Now you might say, oh, Boris, forget it. I ain't qualifying for this. What are you talking about? I've got a business to run. I put in 100 hours per week on that business. Hold on, hold your horses. Tax law is written in a way to help you take advantage of it and to incentivize you to take advantage of it. You're correct. If you work 100 hours in your business a week, you won't be able to qualify 50% use in real estate, right? But if you have a tax preparer, you definitely won't qualify. What you need is a tax advisor, somebody who can plan with you a strategy. Can you still qualify as a real estate professional while you have another job or running a business? You absolutely can. And there's a strategy around it. And as long as you strategize your financials, your hours that you put in your business, and taking advantage of the fact that you also might be married or looking to get married and how we can utilize that spouse, all of that is part of tax planning. And that is how you can write off your real estate and become a real estate professional under the definition of the IRS code, right? So once you become a real estate professional, you meet that qualification. You do not need a real estate license. What do you do next? You have to actively participate in the real estate that you invest in. You have to meet active participation hours, which is 500 hours. You can combine all of your properties together as a one activity, which is like, bam, that's like a gold mine right there. People ask me, how do I pay less in taxes? I had somebody in my office yesterday, actually here in this office, was sitting right here and we're talking about it. I said, look, we can do tax planning. We can find you write-offs. We can probably find you anywhere between $100,000 to $200,000 in write-offs in your first, second, third, or fourth year doing advisory and tax planning. But if you want to wipe out your income and really, really take the huge deduction, you've got to start looking how to invest in real estate. Whether it's creating passive income from other businesses, create a passive losses in real estate, or converting yourself as a real estate professional. All of that is possible. Now, Donald Trump, he's using depreciation because he knows the game. He read the tax code. He's like, when he had that debate with Hillary Clinton, he's like, lady, I'm just using the tax code. Like, think about that. By the way, he's not the only one. Come on. I think he's the only one who's doing this. It just happens to me he's in the media about it, and he's very, very vocal about it. All right, enough about this. Let's continue. The second tax strategy. Now, I reviewed Donald Trump's 2015 Schedule A itemized tax deductions. Now, what I've noticed is that he donated $21,000. You see, donations other than cash. Now, I know there are three things that were happening in 2015. It's some complex stuff that he was doing, which we're not going to talk about here. But I tried to review the statement 18 over here that says, I couldn't find it in his tax return, but I made my own assumption that one of the things that he has done with his donations, again, it's my personal assumption, just reading this, because I know what he, I've seen in the media where they talk about the donation, the charity donations that he was taking, how he was taking, all that stuff. But when I saw this, I was like, wait a second, This is another thing I can share with my viewers on YouTube, right? And what I'm assuming that part of this $21 million other than cash donation is stock and asset donation, an appreciated asset. Now, this is, by the way, is a beautiful strategy, like super, super beautiful. Like you don't even have to do like, I don't know, like there's no extra work involved in doing this. It just requires knowledge, right? That's why I always say, if you have a tax preparer, you do not have a tax advisor. Now, here's the thing. IRS says, look, IRS says, look, Habibi, I don't know if those of you know what Habibi means, right? IRS says, look, Habibi, right? Look, my dear friend, we understand you like to give cash donations, but we're also going to allow you to give donations other than cash. You own stocks, you own assets, you own securities. Why don't you donate it to a nonprofit organization? Like, oh, okay, great. How does that work? And the IRS says, you know what? We love and respect the rich people, so we're going to give them a well, that's not what they said, right? But we're going to give them a little bit of a, what is that? We're going to give them a little bit of a nice tax break. So IRS says the following. If you hold an asset for more than a year, 12 months or more, it is considered a long-term asset. And when you donate a long-term, when you donate a long-term asset, let's say you own a stock, right? You donate that stock, you can write off the appreciated value without reporting the income on your tax return. So, whoa, did you hear what I just said? Let me give you an example. You bought a stock, $100. That's it, $100 you put in Robinhood, whatever that is, boom, done deal. 14 months later, boom, the stock went up to $1,000. And you are a generous person. You like to give cash donation, right? You're like, hey, let me give cash donation, and every day you do your tithing or whatever that may be. Or you can donate your appreciated stock. The way it works is that you give the stock that is now worth $1,000 to a nonprofit organization of your choice. Of course, it has to be a qualified nonprofit organization or a church or a synagogue or whatever it is you give it to, right? You give the money to them. Now, what happens is that you get a write-off for $1,000 without reporting $900 profit that you made, the capital gain. Now, you might think, Boris, that's common sense. No, it's not. Because what happens is that, let's say you did not donate the stock. Let's say you sold the stock. You record $900 gain, and then you give the cash to the organization, you record $900 deduction. It's a wash. But when you donate the appreciated stock over 12 months directly to a nonprofit organization, well, guess what? You do not report the $900 income. Instead, it goes straight for the deduction. And if you're a generous person that used to give cash, the cash doesn't even have to leave your pocket. So not only did you not pay tax on the gain, but you also got a write-off on it. Do you see the double dipping that I see? Ladies and gentlemen, if you're one of those people that gives a lot, and I've met a lot of generous business owners, and you have some appreciated assets, that's the way to go. That's the way to go. So gain is not reported on your tax return, and there's no capital gains tax. So when I looked at his tax return for 2015, I'm like, I am sure that is something like that is done here. And I'm like, that's why he pays in taxes what he pays in taxes. Now, does Donald Trump use a C corporation as a tax strategy? What are really the benefits of the C corporation? You guys remember Tax Cuts and Jobs Act that was passed 2018 when he became president? Bam, they slashed the tax rate to 21%, the corporate tax rate. Everybody's like, oh, Donald Trump is just doing it for his own benefit. He's the rich guy and he's just doing this for himself. Well, guess what? If you review his tax returns, he's got like gazillion pass-through Schedule C entities. Now you might say, what? Schedule C? Doesn't that self-employment tax? Yes, it is. Check. Actually, as a matter of fact, let me show you something. Let me pull up the tax return. If you take a look right here, 2016 and 2017. Can I move this? Yes. Let's see. Self-employment taxes. You'll see a line right here, 57. 135,000. The other one is another double-digit number. This one is not a double digit. This one is way less in 2015. But yes, he does pay self-employment taxes. Okay. Now, why does he do that? This guy is a smart guy because he knows that some of his businesses will have and will produce losses. It's like, I don't want that loss to go to waste in a C corporation. I might as well just deduct that loss and my personal return against my other income. So he's got pass-through entities that are reporting income, and then he's got pass-through entities that are reporting loss. And those losses are deducted against the income. So he's using the power of pass-through entities. He's got a bunch of LLCs that are reported on a Schedule C. Why is he not using a C corporation for all of them? He doesn't want to bury those losses. He's like, why should I? Why should I? Right? So is C corporation powerful? It is in its own way, and you need to know when and how to use it. Are pass-through entities powerful? They are in their own way, and you need to know how to use it. That is why if you have a tax preparer, you do not have a tax advisor, ladies and gentlemen, I strongly recommend, if you want to pay less in taxes, you do tax planning and get yourself a tax advisor. Thank you so much for watching this video. I hope this was helpful. Let me know in the comments if you guys love it, any questions, and till the next time.